Welcome to episode 17 of the SaaS Report. I'm your host, Matt Aird, the founder at Sales Science. And today we're going to be taking a look at Q1 earnings from Box Salesforce, UiPath, and PagerDuty. We're then going to take a bit of a sneak peek into the Q1 State of SaaS metrics report. And specifically, we're going to look at some early data that we've got on CAC payback periods and ARR growth rates. So we've had about 2/3 of the companies that we track report Q1 results at the time that I'm recording this. And so we've got some preliminary data, which is pretty interesting. So I'm going to take you through the early data that we have on those two metrics. And then we're going to finish out today by taking a look at Klarna's decision to roll back humans into the customer service function. Quite a U-turn on their kind of very outspoken approach to using AI to generate efficiencies in this department late last year. So let's get into it. UiPath reported Q1 results last week and they weren't great. Almost every key metric was down year over year. So let's go through them one by one. ARR growth was down to 12% from 21% in Q1 last year. CAC payback was up to 96 months from 63 months a year ago. Rule of X was down to 54 from 71. We also saw gross margin go down a point, free cash flow went down a point, but it's really their declining ARR growth rate that's starting to hurt them. As we can see on this chart here, there's just been this consistent quarter after quarter decline in ARR growth rates for UiPath over the last couple of years. From almost 100% growth in early 2020 down to just the 12% that they recorded in Q1 of this year. And shockingly, again, right, that was down from 21 just a year ago. So we've seen ARR growth rates almost halve in the last 12 months off the back of this continuous slide over the last few years. One green shoot for them though, there was a pretty substantial improvement in operating margin. That came in at -5% for the quarter versus -15% a year ago. They get there through pretty substantial cuts to sales and marketing OpEx. That was just $160 million for the quarter, or about 45% of revenue. That was down from $180 million for Q1 last year, which was about 54% of revenue. G&A spending was down pretty significantly as well, so that came in at 15% of revenue this year. That was at 19% of revenue in Q1 last year. So UiPath is one of those companies that has both kind of a massive opportunity and a massive risk in the market right now from the rise of kind of AI and agentic. They've built a pretty substantial business around automating workflows for customers, and they've done this through robotic process automation. And so what that means is that they've likely got the inside view on what these large enterprise organizations are trying to automate or what they would like to automate within their businesses. They've done that historically through RPA. It's possible that agentic workflows open up additional use cases, but the question here for UiPath is whether or not they're going to be the company that captures a large portion of this next share of market, or does some of their existing use cases get eaten away by new vendors competing in the space. So time will tell. They've got a market cap of about $7 billion, or about 4.1 times first quarter ARR. Salesforce reported Q1 results recently as well, and I always get blown away when I look at Salesforce's income statement, right? Just listen to some of these numbers. So in Q1, they did $9.8 billion in revenue. $532 million of that was services revenue, right? So that made up just 5% of revenue for Q1, but was over $500 million, which is just insane. They spent about $1.5 billion on R&D, which is about 15% of revenue, $3.4 billion on sales and marketing. That's sitting at about 35% of revenue. And they generated just over $1.9 billion in operating income. So they got a 20% operating margin. 64% free cash flow for the quarter. So Q1's always a big free cash flow quarter for Salesforce. So that represented $6.3 billion in free cash flow for the quarter. If we look at this historical free cash flow rates for Salesforce, it's insane at this point. They are the definition of a cash flowing machine. This chart here shows that they've generated about $24 billion in free cash flow over the last 8 quarters. They also reported RPO of just under $61 billion right now. But as we all know at this point, right, growth is slowing. 8% ARR growth year over year. That's down from 12% a year ago. So that represented just over $2.8 billion in net new ARR for the year. And they spent $13 billion on sales and marketing over the last 4 quarters to generate that growth. So that gives them CAC payback over the last 12 months of 67 months, magic number of 0.22. But Salesforce is a company at a bit of an inflection point, right? Their focus now is on their Agentforce product and this rollout. The acquisition of Informatica is going to play a large part in that. I touched on that in last week's episode, so you can check that out if you haven't seen that yet. We got a quick update on Salesforce's Agentforce rollout in these Q1 earnings. So they reported that they've done 8,000 Agentforce deals now, of which about half of those are paid. That's up from a reported 5,000 deals from Q4 of last year, where they had 3,000 of those paid. So this is going to be really fun to watch over the next few quarters as this, kind of agent platform battle develops in the market. Salesforce really seems to be going all in on this, and it'll be interesting to see if this can help them to continue their growth and their cash flow generation over the next couple of years. At the time of recording this, Salesforce had a market cap of about $253 billion. That's about 7 times first quarter ARR. Box also reported Q1 earnings this week, and the theme of outrageous CAC payback metrics continues. We saw one of those for Workday last week. We get another one here with Box. So over the last 12 months, they spent $380 million on sales and marketing and generated just $46 million in net new ARR as a result. So that gives them a CAC payback of 126 months over the last 12 months. If we look at quarter CAC payback over the last 6 quarters, the picture isn't great, but it is starting to trend down, right? So they reported quarter CAC payback of, just over 250 months in January of 24. That's starting to trend down, but we don't get a quarter CAC payback metric for Q1 this year because they were negative on ARR quarter over quarter, right? So no additional ARR quarter over quarter from Q4 to Q1 this year, which means we can't calculate a CAC payback metric. But dig a little bit deeper here, and there are some green shoots. Billings were up 27% year over year in Q1. Now, billings isn't something I've talked a lot about on the podcast, but basically what it is it's the total amount of invoices that a company issues in the given quarter, right? So this will include invoices to customers that are paying kind of quarterly in advance or annually in advance or paying, multi-year deals upfront. But this revenue won't necessarily be recognized in the Q1 numbers, right? Because the revenue will be recognized in the quarter in which it applies. So the fact that billings is up 27% whilst ARR growth is down quarter over quarter is kind of the positive sign of the coin, so to speak. On top of strong billings growth, they also had strong RPO growth. That was up 21% year over year to just under 1.5 billion. And it looks like they've also turned the switch back on in terms of growth mode or trying to chase growth. So OpEx spending is up. Spending on R&D jumped 15% year over year. Spending on sales and marketing jumped 7% year over year. And both of those increases obviously outpaced revenue growth, which came in at 4% year over year. So starting to invest more in R&D and sales and marketing, looking to get those wheels turning again. NRR was flat at 102%. Free cash flow margin came in at 31% for the quarter. So some signs of life, right, for Box, possibly, after a pretty terrible last 12 months. Share price is up a little bit over that time frame, so they're trading at a market cap of about 5.6 billion or about 5 times Q1 ARR. PagerDuty reported Q1 results, and growth is pretty slow for them, just 8% ARR growth year over year. And when you're a company that's doing less than $500 million in ARR, that's certainly not where you want to be. And if we look back at the ARR growth trend over the last couple of years, we can see that July of 22 was sort of the beginning of the end of these high rates of growth for PagerDuty. We've seen this steady decline quarter after quarter since that time frame. Now, this slowdown in growth wouldn't be unexpected if you're a company doing, billions of dollars in revenue, right? As a company scales, it becomes much harder to generate high rates of ARR growth because you're trying to grow from such a large base. But PagerDuty isn't that at all, right? They're still a company doing less than $500 million in ARR. This is actually the 10th quarter in a row that they've spent between $400 and $500 million in ARR. So they're really struggling to get over that next milestone, and growth is really starting to stagnate. Compare that to the best companies, right, that we see, and they blow through this run rate, right? So Monday at $500 million in ARR was growing at 30%. CrowdStrike was growing at almost 100%. Even, HubSpot was growing in the mid-30s through that 500 million ARR mark. So go-to-market efficiency is the big problem for PagerDuty. Magic number was only 0.17. CAC payback was at 84 months over the last 12 months. Some positive signs for them though. Operating loss more than halved from 21 million down to 10 million year over year. That comes from an almost 10% cut to the R&D budget and a 2% trim on G&A as well. Spending on sales and marketing was actually up 3% year over year. Free cash flow came in at 29 million. That's a 24% free cash flow margin for the quarter, but the share price is at an all-time low. They've got a market cap of 1.38 billion or about 3 times Q1 ARR. So the Q1 State of SaaS report will be live in the next couple of weeks. For those of you that have been following along, we've got the State of SaaS data sheet, which is live now, where you can get access to the raw data. If you want to get access to that, I'll link it below this video. But what we're going to be doing in the next couple of weeks is releasing the full Q1 State of SaaS report, where we look at the trends across all of the core SaaS metrics for the 30 odd companies that we track and look at them compared to kind of rates that were generated in the prior 2 years, right? What I wanted to do in this segment today was to take a bit of a sneak peek into a couple of the core metrics that we're going to look at in that report, based on some of the earlier reporting that we've had from companies, right? So about 2/3 of the companies that we track have reported Q1 numbers now. So we can start to get a bit of a feel for the trend that we're going to see as the remaining companies report as well. Now, what I wanted to do today was dig into two of the core metrics, CAC Payback first of all, and then we'll take a look at ARR growth rates. So starting off with CAC Payback, what we can see is that CAC Payback trends are increasing year over year, right? When we look at this from a median standpoint, so the median across the companies that we track that have reported so far, basically flat year over year. But when we look at the mean, we can see a big jump from 33 months in Q1 of last year up to 54 months in Q1 of this year. And then when we dig into the detail and look at this on a company by company basis, the drivers behind some of this become a bit clearer. So 9 of the 23 companies that we track had CAC payback in excess of 50 months. That was only 5 companies in Q1 of last year. Only 7 of the companies that have reported so far had CAC payback under 30 months versus 9 of the companies had CAC payback under 30 months for the same period last year. And as we can see in this chart here, we've had some big jumps on an individual company basis. Palo Alto Networks jumped from 40 months to 159 months. Box jumped to 126 months from 105 months. And even the historically kind of super efficient Atlassian almost doubled, right? So they went from 10 months to 18 months year over year, right? So not a great picture on the CAC payback front, but what is the core driver behind this? Well, it's the same as always, right? It's lower growth rates. What we see with these SaaS companies is that they seem to be pretty hesitant to reduce spending on sales and marketing too much, right? And probably for good reason. They don't want to unnecessarily give up market share, right? Most of these companies are free cash flow positive, which means they can continue to invest for growth, right? And so they don't want to pull back on that spending unnecessarily and allow competitors to take market share from them. And so what we see is, whilst that sales and marketing spend remains kind of largely stagnant, these growth rates over the last few quarters have been dropping pretty significantly. And we can start to see that as we dig into the data. So median growth rates for the SaaS companies that have reported so far dropped to 16% year over year versus 23% in Q1 of last year, right? That's a 30% decline in growth rates over the last 12 months. And again, when we dig into the chart and look at this from an individual company basis, we can start to see some of the drivers behind that. Last year's Q1 numbers saw only 3 companies report single-digit ARR growth. That was up to 4 companies this year, so those are Zoom, Box, PagerDuty, and then we also had Salesforce, who dropped from 12% down to 8% this year. Zoom, Box, and PagerDuty all reported single-digit ARR growth rates in Q1 of last year as well. There were only 8 companies last year that reported growth rates lower than 20%. That ballooned out to 15 companies in Q1 of this year. And at the upper end of the chart, last year we had 6 companies growing faster than 30%. That's down to just 3 companies in Q1 this year, right? However you want to chop it up, whether you're looking at the slower growing companies, the ones in the middle, or the ones at the top end, right? Growth rates are down across the board. And there are some that have moved quite sharply year over year. So when we take a look at this chart, we can see Atlassian's growth dropped 22 points year over year. SentinelOne was down 17 points. Procore and Viva saw 10-point reductions in ARR growth. And HubSpot was down 8 points from 24% to 16% year over year. Now, some of this is natural, right? As these companies get larger, it becomes harder to generate high rates of ARR growth. But the drop-offs here seem significant, right? This isn't kind of an orderly decline. There are some really big swings here year over year that we're starting to see, right? We saw them in Q3, we saw them in Q4, we're seeing them again here in Q1. These growth rates are really starting to drop at a quick rate. And it's not just for kind of the average performing companies, right? Some of the companies that have historically grown very steadily and very strongly, right? And I'm thinking companies like Atlassian, Viva, right? HubSpot, even they're struggling to grow in this environment, right? Which tells you something about how difficult it is to generate top line growth at the moment. Klarna is hiring humans again. Klarna's been one of the kind of highest profile companies that we've seen talking about how they're using AI to revolutionize their business. First, they announced that they had developed an AI customer support agent that was able to do the work of 700 customer support agents. And the stats that they reported around this last year were pretty significant, right? So I'm just going to read some of these to you. They told us that their AI assistant had 2.3 million conversations, which represented about 2/3 of Klarna's customer service chats. So it was doing the equivalent work of about 700 full-time humans. They told us that the customer satisfaction scores on the AI cases was on par with human agents, and it was more accurate in errant resolution, leading to a 25% drop in repeat inquiries, right? So customer satisfaction was the same, repeat inquiries dropped 25%, and then time to resolve queries dropped significantly as well. So they told us that the cases were resolved in 2 minutes compared to 11 minutes when it was just humans doing the job. So that was kind of the first AI use case for Klarna, right? And I remember when that news came out, it really shook up the space, right? This was one of the first really large scale kind of use cases that we'd heard of AI kind of replacing humans in the workforce and doing it in a way that not only made it cheaper, but generated better outcomes than humans had previously, right? So super interesting story. Then after that, they announced a few months later that they were getting rid of some really core kind of SaaS applications that they use to manage their business, right? So I think they'd mentioned that, they were replacing Workday and Salesforce with AI applications that they had developed internally, right? So two big kind of AI focused stories around Klarna caught the headlines. I think we reported on both of those on the pod last year. Well, news came out this week that Klarna is going back to hiring human customer service agents, right? So Klarna CEO Sebastian Siemiatkowski told Bloomberg that the AI-focused strategy Klarna employed for the past few years wasn't the right path. He says that while AI customer service chatbots were cheaper to employ, they resulted in lower quality output. That's interesting, right? That seems to be counter to what they announced in the press release when they told us that AI was doing a wonderful job here, right? And so what he said to follow on from that is that investing in quality of human support is the way of the future for us, right? So if you're listening to that and you're confused, right, you're not alone, right? If we look at the stats that they announced, right, and I'll highlight kind of the key ones again, 25% drop in repeat inquiries, customer resolution time down to 2 minutes compared to 11, and outcomes on par with human agents in terms of satisfaction scores, right? Where was the issue, right? Something seems off here. It could be, so Klarna's preparing to file for an IPO. It could be that this is just another way for them to get into the news, right? This announcement runs completely counter to everything that every other large tech company is saying. Right, you've got Satya Nadella on stage talking about how a lot of code is written by AI agents at Microsoft now. You've got all of the big tech companies doing mass layoffs. You've got Salesforce announcing that they're no longer hiring human developers, right? And then Klarna comes out and says, oh no, actually we're going back to hiring humans, right? So that counter narrative is going to catch attention, right? And what it does is it allows them to get back into the news. And so it could be that this is kind of just smoke and mirrors, right? That they aren't actually increasing the pace of human hiring in customer support. Yes, they may be needing to hire humans to replace kind of some of the churn that takes place, but they don't actually have plans to increase the kind of size of that department overall, right? I don't know what it is, but either the initial pilot details were misleading or this backtrack isn't really a backtrack and it's just another brilliant PR play by Klarna to catch some attention, to grab some headlines, to stay relevant and top of mind for people so that when that IPO comes, right, people know who Klarna is and they want to get involved in it. One to watch for sure. I wouldn't be surprised if we get another kind of AI related announcement out of this company at some point over the next couple of months. All right, that's it for this week. Thanks for tuning in. Q1 State of SaaS report will be out in the next couple of weeks. So if you want that, hit me up on LinkedIn, comment below. I'll make sure you get added to the mailing list so that as soon as that launches, you're able to get access to that. Thanks for tuning in this week. If you've got any suggestions, if there are any topics that you want me to cover, let me know. I'll see you guys again here next week. Until then, goodbye.